The third learning objective is to prepare a statement of cash flows by the indirect method. To prepare the statement of cash flows, you need the income statement and both the beginning and ending balance of cash, or balance sheet. Step 1, lay out the statement format as shown on the next slide. Step number 2, compute the change in cash from the comparative balance sheet. The change in cash is the key reconciliation figure for the statement of cash flows. Step number 3, take the net income, depreciation, and any gains or losses from the income statement. Step 4, complete the statement of cash flows using data from the income statement and the balance sheet. The statement is complete only after you have explained all the year-to-year changes in all of the accounts on the balance sheet. The statement of cash flows, or the indirect method, begins with net income because revenues and expenses which affect net income produce cash receipts and cash payments. Revenues bring in cash receipts and expenses must be paid, but net income is accrual based and the cash flows, cash basis from net income, don't always equal accrual basis revenue and expenses. For example, sales on account are revenues that increase net income, but the company hasn't yet collected cash from all of those sales. Accrued expenses decrease your net income, but you haven't paid cash if your expenses are accrued. Go to the net income to cash flow from operations. We must make some adjustments to net income on the statement of cash flows. These additions and subtractions follow net income and are labeled adjustments to reconcile net income to net cash provided operating activities. Step 1. Gather the income statement and both the current year's and the prior year's balance sheets. Take the following figures from the income statement: net income, depreciation, and any gains or losses. Depreciation, depletion, and amortization expenses are added back to net income to reconcile from net income to cash flow from operations. Depreciation does not affect cash because there is no cash account in the journal entry. Depreciation is a non-cash expense. However, depreciation, like all other expenses, decreases net income. Therefore, to go from net income to cash flows, we must remove depreciation by adding it back into net income. Sales of long-term assets, such as land and building, are investing activities, and these sales usually create a gain or a loss. The gain or loss is included in net income, which is already in the operating section of the cash flow statement. The gain or loss must be removed from net income on the statement of cash flows so the total cash from the sale of the asset can be shown in the investing section. Step number 2. Compute the change in cash from the comparative balance sheet. The change in cash is the key reconciliation figure from the statement of cash flows. Most current assets and current liabilities result from operating activities. For example, accounts receivable result from net sales. Inventory relates to cost of goods sold, and so on. Changes in current assets create adjustments to net income on the cash flow statement. An increase in a current asset other than cash causes a decrease in cash. It takes cash to acquire assets. If accounts receivable, inventory, or prepaid expenses go up, then cash goes down. Therefore, subtract the increase in the current asset from the net income to get cash flow from operations. Conversely, if a current asset other than cash goes down, cash goes up. If a current liability goes up, cash goes up. If a current liability goes down, cash goes down. The payment of a current liability decreases cash. Therefore, we subtract decreases in current liabilities from net income to get cash flow from operations. The adjustments from the income statement and balance sheet are now added to our statement of cash flows format. Refer to the back sheet for changes in accounts receivable, inventory, accounts payable, and accrued liabilities. Operations provided net cash flow of $70,000. This amount exceeds net income of $40,000. Investing activities affect long-term assets, such as plant assets and investments. To prepare the investing section, you need to analyze these accounts to determine the activity. Use of T accounts is very helpful. Also, if a gain or loss appears on the income statement, a long-term asset has been sold. Companies keep a separate account for each asset, but for computing investing cash flows, it is helpful to combine all the planned assets into a single planned asset account. We subtract accumulated depreciation from the asset's cost in order to work with a single net figure for plant assets. We don't care about the gain itself, but we need to know the amount of cash received from the sale. Remember, we are looking for cash movement. How much cash did the business receive from the sale of plant assets? First, let's look at the cost of the sold assets. This will be the missing value in our plant asset net T account. Cash received from selling plant assets can be computed by using the journal entry approach. The $40,000 book value comes from the plant assets net account on the balance sheet. The gain or loss comes from the net income statement. The missing amount must be the cash received from the sale. As we stated previously, companies keep a separate account for each asset, but for computing investing cash flows, it is helpful to combine all the plant assets into a single plant asset account. We subtract accumulated depreciation from the assets cost in order to work with a single net figure for plant assets. This simplifies the computations. Recall that assets cost minus accumulated depreciation equals the book value of the asset. So the plant assets net account holds the book value of the plant assets. Financing activities affect the liability and owner's equity accounts, such as long-term notes payable, bonds payable, common stock, and retained earnings. Again, T accounts are helpful in finding amounts needed for the statement of cash flows. Long-term notes payable is increased by any new borrowings and decreased by payments. The beginning and ending balance of notes payable or bonds payable are taken from the balance sheet. If either the amount of new issuance or payments is known, the other amount can be computed. The computation of notes payable uses the balance sheet amount from the long-term notes payable account to create the incomplete T account. Cash flows for these financing activities can be determined by analyzing the stock accounts. For example, the amount of a new issuance of common stock is determined by analyzing the common stock account. If new issuances or payments are known, calculate the other. If unknown, review account for debits and credits. We would have to be told if there were any stock retirements. Since there were no retirements, we know the balance change must be represented by new stock issuances. Cash flows for these financing activities can be determined by analyzing the treasury stock accounts. For example, the amount of the new purchase of treasury stock is determined by analyzing the treasury stock account. Since we're not told that any treasury stock was sold, we must assume that 100% of the account change represents the new acquisition of treasury stock. The amount of dividends can be computed by analyzing the retained earnings account. Retained earnings increases when companies earn net income. Retained earnings decreases when companies have a net loss and when they declare dividends. We know that net income of $40,000 was earned from the income statement. A company can't have both net income and net loss for the same period. Therefore, the missing value must be the amount of the dividends declared. The next line of the cash flow statement underneath net cash provided by financing activities represents the total change in cash for the period. The beginning cash is listed as $42,000. The net decrease of $20,000 is subtracted from the beginning cash of $42,000, which equals the ending cash balance of $22,000. This is the key to the statement of cash flows. It explains why the cash balance decreased by $20,000, even though the company reported net income for the year. Short exercise 14-5 reviews the computations of cash flows from operating activities using the indirect method. The exercise continues on this slide. Short exercise 14-6 focuses on computing cash flows using the indirect method. The exercise continues on this slide. And this concludes this lecture. Please stay tuned for the next one.